He attended the Ivy League's University of Pennsylvania Wharton School. After earning a 3.89 GPA, Azizzi transferred to Harvard University, where he earned his bachelor's degree. He went to work for Lehman Brothers, Julius Baer, and Artio Global Investors. He also funded and led an e-commerce company in Asia Pacific to acquisition. Upon returning to the States, Azizzi participated in IPOs for 3 Silicon Valley unicorns and was a founding member of DoorDash, DoorDash for Business, Vertical, where his direct efforts helped more than triple his revenue to $885 million and take the lead in the U.S. market. Rahid, glad to have you on the podcast in this episode, brother.
Hey, thanks for having me, guys.
Absolutely. Very quickly, what do you think about the podcast, which is our YouTube channel and the Facebook group, the type of information we're sharing for those who are out there?
I think you guys are giving away more information than most people charge a ton for. And if people really want to know how to do this, do these things, this is where they need to be.
Great, and we're glad to have experts like yourself be a part of us. So Rahim has plenty of experience regarding IPOs and fundraising. So let's touch on that. Let's start with public companies. The big question, Rahim, do you need a board of directors to go public? Rahim, are you there?
Yeah, I was disconnected for a moment.
Yeah, like I said, do you need a board of directors to go public?
Yes, but not in the traditional sense. I think when people think board of directors, they're kind of thinking the way Mr. Pena said, you're kind of borrowing, you're getting people, you're going on LinkedIn and you're trying to find people to fill your board. It's not really like that, but you definitely want to have a strong board because that's what's going to attract investors.
Right. Now, the majority of members have the goal of exiting later down the line, right? What is the best way to go about it? An IPO or a strategic private sale to a larger player or a private equity firm? What do you think?
Well, yeah, I'm going to be partial, right? I'm going to say an IPO, and you want to go public sooner rather than later, so you can retain as much equity in the company as possible. And not only that, you're going to 10x your value usually when you go public. So you can try to do it with an acquisition or something like that. But if you go public, I mean, the game changes. Everything just opens up and everything is different. And your company is just worth so much more.
Right. Now, what are the requirements you're looking at to be able to go public?
Yeah, great question. So I deal, kind of in Main Street. You do have the big things that you hear about in the Wall Street Journal and things like that. Those are going to be handled by the bulge bracket, the Goldmans, the JP Morgans and things like that. I kind of handle like where Main Street is. My goal is to make going public available to smaller businesses. So the smallest that we've actually taken public had 100K in revenue. Okay. And we were able to do it. And it's different. Wow. The rules are different when the rules are much, much different when you're dealing with a smaller business as opposed to, the big things you read about in the Wall Street Journal. But pretty much like I like to tell people, virtually any business can go public and no business is too small to go public. I know they've been told that. I know VCs say that, and they've probably heard that somewhere, but that really isn't true if they really want to go public.
Great. Now, those small businesses, we're talking about the penny stocks, right? What people hear about?
It depends. It depends on what the raise is, but they can be listed on something like that, Pink Sheets, OTC. But I don't want people to kind of get kind of some people say it's gives it a bad name. Oh my God, it's on the Pink Sheet. Oh, it's on this. But here some of the best known companies in the world trade on the OTC and the Pink Sheets like Heineken, Nestle, Nintendo, Rolls-Royce. I know you're a car guy, Volkswagen. Right. I could go on Cathay Pacific Airlines, L'Oreal, Peugeot, which is a French car maker and bike maker. So some of the biggest companies trade there, and the reason they do it is because of the reporting requirements. Some have less stringent reporting requirements than others, so they choose to list there, and some less expensive as well.
Nancy, hop in.
Yeah, so just right before we started the podcast, me and you were having a small discussion, Rahim, and it was I was kind of baffled by it, if you will. So let's just touch on that a little bit more. A SPAC is like a blank check. Is a blank check.
Yeah.
Right? and we're basically
Right.
selling an idea. But the thing is, we don't know what we're going after. Is that correct? We don't know what kind of
You,
target we're going
yeah, you hit the
after.
nail on the head, and that's why
So
they're
how
called
do
blank check companies.
so how do we actually get investors in on this?
Okay, so are we all familiar with A-Rod Alex Rodriguez is?
I've heard that name a few times.
The baseball player, he's married to Jennifer Lopez. He just completed a
Yes.
SPAC. So what he's doing with his SPAC and his partners, they're going to acquire things in the sports management vertical. Okay, so they don't have anything yet. You just give them an idea and say, hey, this is our company. We're looking to raise money because we want to make acquisitions in this vertical. Okay, that's why they call it a blank check company, because you have no specific target yet. So the government says, yes, we will let you do this, but you do have a finite amount of time to comply with Rule 419 so that you can consummate something. So it isn't just the money's going to be sitting there forever. You have to do something with it once the funds are raised.
And generally speaking, do you need some kind of a team that's going to be able to, help with the governance of everything, and pinpoint the targets that you're going after, right? I mean, of course, you have a general idea, but like you just said, it's nothing that's concrete. So would you need a team to come in and say, okay, look, you say you want to make acquisitions, in this space. Generally, these are the good companies, something like that to that effect. Or if you already have targets, would you still need a team anyway?
I would say from an investor standpoint that you're going to pacify a lot of investors if you say, hey, we want to buy some stuff, let's say like Alex Rodriguez in the sports management thing. And I say, oh, Hall of Famer Alex Rodriguez, Evander Holyfield, Oscar De La Hoya. It's going to make investors feel a lot better because they have, they can borrow on their celebrity and say, okay, I know that this is their vertical, this is their wheelhouse, and this is where they're going to buy. You see what I'm saying? So you definitely are going to look a lot better with investors if you have some people on your team who, let's say you want to go into the fintech vertical and this guy was one of the founders of PayPal or something like that, just to make an example. It just makes your case so much stronger than if you're just like, hey, I want some money and we've never done this before and things like that, because everything comes down to a story, right? And you want to sell your story to investors. So you want to have a team there who's already been there, who has walked the walk and who already has experience doing it.
Okay. So like, I like to get to the basically to the simplest form of understanding something. For example, the guys that you just described, they have a background. They're famous. Everybody knows them. So it's going to be a lot easier for someone like me, or anyone else that's not so famous, if you will, to get these investors. Do me a favor. Just give me a scenario of a SPAC from your experience, something that you've seen. Nothing too big, but nothing too small either, right? Maybe I don't know. They want to go public. It's $20 million, the $20 million valuation business. What does that look like?
In terms of which way? What does it look like? What do you want to make sure I'm answering the right question?
That was kind of two questions. So let me back up a little bit. Layman like me, like myself, don't have 6 figures in the bank, 7 figures, 8 figures, any of that, but I want to attract investors. And I say, hey, I want to do something in healthcare, but I'm not, sure exactly what it is. But I want to do a SPAC. I want to attract investors. How would I do that? What do I need?
I would say, so, going back to what I said is the best thing comes down to a story, right? Because everybody loves a good story. I would say hiring an investment marketing firm. And when you work with those people, they're going to get your story down and they're also going to get it out to potential investors. And so they're going to be able to see what you're trying to do. And if they can buy into your story, you make it exciting enough, they're going to want to join in. That, it all comes down to a story, whether it's an IPO, whether it's, Reg A plus, Reg CF, it all comes down to having a good story first. And also you want to have the backing behind it, meaning you have the muscle, you have the intelligentsia to pull it off. So I would say those two things.
Right, great. Now let me hop in. Let's keep talking about IPOs. Now, there's a big thing I had in mind. When you do go public, how can you liquidate your stocks, your holding equity, essentially without making the price drop, scaring investors, or affecting operations much? Or are you just stuck with a lot of stocks valued at millions or billions, but can't do much with it.
So it sounds like you're talking about like non-diluting, right?
So I understand when you sell stocks, you're going to lose a portion of your company. But if you went public and you own, let's say, 80% or 70% and it's valued at, per se, $1 billion, how can I cash out some of that without,
Yeah.
scaring people that you're selling a lot of stocks, right?
Yeah, yeah. So you definitely want to be kind of strategic when you do it. And it's so funny because when a company goes public, you have 180 days, kind of the hold period, right, for people who have, who are holding RSUs, restricted stock units. And then you usually see a dip, right after that because people are selling. So you want to be strategic about it, but, it depends on what vehicle and, what's been written into it. One thing, we have, is that, it's anti-dilutive where, hold on one second, I want my phone to shut off here. Okay. Where one cannot convert, they can't convert the common stock. Okay. So what it is, it's a variant and it's anti-dilutive convertible preferred. Okay. I know that's a lot to say right there, but the whole point of it is for what you said right there is to kind of have a hedge against people not shorting, but selling the stock and diluting it and making your stock price go down.
Can you get loans against your stock?
Yeah.
Mm-hmm.
Yeah, there's definitely companies you can even get. Let's say your company's private and you're holding some RSUs or you're holding something like that. There are companies out there that you can sell your stocks to.
Oh, great. Now, in regards to running a public company, you're getting audited. Basically, it's a big responsibility. Can you share, how your responsibilities change from being in the private market to the public market?
Yeah, great question. So when you're public, I mean, it's all out there. You're opening the kimono, right? Like they get to see it all. Where a private company, they don't get to see, how much money you're making, how much money you lost, what you're paying people, and things like that. So, and that's kind of a good thing, right? Because you want to see that because if you want to invest in a company, you want to know everything about it before you give them a dollar, right? You're like, okay, so let me check it. Okay, I want to see what they're doing. This, okay, this looks like something I want to invest in, or this looks like something. So that's why reporting requirements are so important. And that's why, you have the SEC and these governing bodies are so strict on it because they want to make sure that the investing public has enough information to make a good decision about whether or not they want to invest in it. So the big thing is, keeping your record straight, all your reporting requirements and things like that. That is like so big because again, you want to make sure that the investing public has that information. Now, if you're private, no one really cares, right? It's like, it's private, and not only that, but your shares private, they're not liquid, right? There's no exchange, there's nowhere for you to sell those shares. Okay, so those are, I would say two of the biggest differences.
Let me ask this, a hypothetical scenario where we lose 20, 30, 40% of our stock value, maybe due to speculation. People got scared or some news reports, something that stirred up. But we're still generating sales and we have steady cash flow. Would we go bust?
No, and that's a great question. I think Ansi kind of hit on this. I think it was last month about the whole, he and I were kind of chatting about the shorting of stocks and things like that. Companies do not go out of business because their stock went down. Companies go out of business because they don't have money. You see what I'm saying?
Makes sense. Yeah.
They don't have money. Yeah. So it's kind of two different things there. But the point is, when something like that happens, they got to kind of get out in front of it. Or, we all like to show billions. If somebody's trying to deliberately short the stock, you got to get like an investment, marketing firm to get your message out there on why your company is safe, why your company is, can withstand whatever storm or whatever is coming.
Great. So for the investors out there that hold stocks in, various companies and the stock price is dropping, as long as that company is still generating sales and cash flowing, we're going to go through a storm. The stock's going to go up, right?
Okay. I missed you. I kind of went out for a second. Say that again.
So for the investors out there, that they hold stocks in various companies, but let's say it's losing value or something happened, media. But as long as the company is still generating cash flow and is able to remain afloat, there should be brighter future for it, right? Like the stock's eventually going to go up. You could hold on to that, or should you sell?
It's so many things. There's so many variables involved. They could get a new CFO, and depending on if he or she is really good, the stock could rise, it could go down. they could they could announce that they got a new contract with the company and with the company or the government, and the stock could go up. I mean, there's so many variables to it. And I kind of tell people, I don't want to go off on a tangent, like
Right.
there's the economy and the stock market, but the way the stock market is say you're walking a dog, right?
Right.
And you're walking the dog in a park, right? And a dog here, they hear a bird, they go run one way. They see a person, they run another way.
Right.
All these things are kind of distracting it. That's the stock market, right?
I see.
It's just kind of like all over the place, and all these things are kind of like distracting and can make it move one way or another. That's the stock market right there. And you got to understand too, the stock market is also forward looking, right? Where the economy is what I say, looking backwards. The economy is about what we already did, right? We can't even do anything
Right.
about that anymore. It's already happened. But the stock market's like what you think the company will do in the future. So it's
Performa.
yeah, exactly. So yeah, the thing about, like you were saying, anything can change the stock price. I mean, and the big guys, the be worrying about little small companies, trading pink sheets or OTCs like that. But they're not going to really worry about those as much. But anything can make the price fluctuate.
Right. Now, you touched a little on this, but as people don't know the facts because they're looking outside in about what's truly happening in a company, much is based on speculation, and that affects the stock price, like you said. How can we maintain a perception to keep investors and future investors at ease, so to speak, that we're still good?
Yeah. So you do have quarterly, you definitely have quarterly statements from the CIO or the CFO where you speak to your investors and you say, hey, this is our outlook, for
Right.
the next quarter. This is what we did. So you definitely want to have those forward looking. You don't want to be overly optimistic. You definitely don't want to be, overly negative. You want to say, hey, this is where the market is. This is where the stock is. These are a few scenarios. It could go this way. It could go this way. We think it's going to go that way because we've done X, Y, and Z. That's pretty much
Right.
how that whole thing works.
Okay, makes sense. Now let's touch a little on acquisitions as a public company. Is there more things that could go wrong or more things to look out for?
If you're acquiring a public company?
No, if you're a public company doing acquisitions, because everything affects news, speculation, so on, more so than a private acquisition. Is there other things that you
Yeah.
have to look out for?
I would say, yeah, it depends on the company, but usually when a company acquires another company, let's say a public company, merges or acquires something else, usually the stock price rises. I mean, you look at Microsoft, not Microsoft, I can't remember who bought Slack. Salesforce bought Slack, so
Right.
there was a little pop in price and things like that. Usually it's a pretty positive thing. But what they have to look out for, of course, they want to definitely do their due diligence and say, how is this going to help us grow? And one thing that's really popular with, a lot of companies is grow by acquisition, right?
Right.
You have a person, you have a competitor and he's taking up 20-30% of the market. And you're like, how can we grow 20 to 30% this year? Okay, we bought them. We just grew 20-30%. You see,
Right.
so it's a very, very smart way to grow really fast.
Yeah, like I tell people, 95% of all companies, the statistics fell in the first 5 years.
Yeah.
Why go through all that? Skip the startup phase, buy an already cash flowing company, and essentially you just skip through that startup phase, right? So
Yeah.
I heard that Google, for example, they sell non-voting stock. That means even if you buy the majority, you can't do anything. How does one go about that?
How does one go about acquiring them? Like common stock and preferred stock?
No. Selling non-voting stock, where if they buy the majority, they still can't call the shots or make the decisions, so to speak, like a protection.
Yeah, it just depends on what's available in the market. Like a lot of these, like if you have common shares and preferred shares, one comes with voting rights, one doesn't. But I mean, they're both freely traded. Usually the ones, that are, come with the voting rights, those are like people who got in early on, and kind of the
Okay.
retail investors never even really get access to that. Those are the people who are like, who funded them very early on and stuff. But as far as the retail investors, once they're on E-Trade and stuff like that, you probably won't get access to those.
Right. Now, forced takeovers with public companies. What do you know about that?
Those were big in like hostile takeovers. Is that what you're talking about?
Yes, hostile
Those were
takeovers.
big. Yeah, those were 1980s when you had like the corporate raiders, Ivan Boesky, Michael Milken. My first mentor, the late Reginald F. Lewis, he was the first African American billionaire.
Right.
where he took over it wasn't hostile, but the thing is, they got smart. So corporations got smart now, and they put a poison pill in there. Okay,
Mm.
and are you familiar with poison pill?
No.
Okay,
Educate me on
so
that.
what? Yeah, so what happens is, let's say I go into your corporation and I say, and it's a public company, I want to buy it, right? So I'm actually trying to buy up the shares. A poison pill, if I do that, it will activate a poison pill, and that's going to allow existing shareholders the right to purchase shares at a discount. So what
Oh,
it's going to do, it's going to dilute my ownership if I get it. So
damn.
they got smart to that.
That's
Yeah.
smart.
Yeah,
Good. Okay, they got
yeah,
mechanisms
so they
now.
got
Yeah.
they got smart to the game, hit to the game on that one.
Okay,
So
let's talk about, can your IPO go south? If so, how you can prevent or minimize the chances of it?
yeah, anything can go south. It depends on who you're working with, for one, depending on the bankers, the broker dealers. If you don't have a good enough story, you don't have enough good enough broker dealers who are saying, "Hey, I like this, and I'm gonna, buy it or sell it to my people." I mean, a lot of things can actually go wrong with it. I mean, just like with anything else.
Right.
And it takes time. That's another. IPOs do not happen overnight. It can take, the fastest I've seen is like 6 months, but they usually
Oh,
take about a
wow.
year to pull off.
Okay.
Yeah, and it depends though. These days, I've seen,
Mm-hmm.
you can file an S1 and you can start doing things. As long as you're a going public company, you start
Yeah.
getting some of the accolades of a public company. If you have a company right now, it's
Yeah.
private, and let's say you file an S1 and you're like, we're in the process of going public. A lot of times, companies will start opening up their wallets to you and saying, "Oh, you're going to go public here. Here's a pipe. Here's some money. Here's a
Oh,
line of credit."
nice.
Because
Haha.
yeah, because they know you're going to be kind of like this elevated, status in a little bit.
Right. Now, can you buy back stock to regain equity?
Oh, absolutely. It's done all the time. Absolutely.
Great. How can you go about increasing the value of your shares?
As a business owner or as
Yes, as the business owner, you own your company. Let's say your shares trading at $2, $3. What can you do to bring it up to 3, 5, 10?
there are so many things you can do. Like I said, bring the right people, getting new contracts, and everything you do, you kind of want to let the world know about it, right? So let's say you
Yeah.
got a new contract with Google or Amazon. You get your investment marketing service to kind of blast that out to everybody, and everybody's
Right.
like, "Whoa, this company is doing something. The price is going to rise." You got to play that game. You definitely got to have your PR game has to be tight.
Right. Basically keeping up the hype, right?
Exactly. Exactly.
Okay.
Again, we're in the future, right? We're talking
Yeah.
about the future, right? So
Right, right.
you want the hype to be strong.
Correct, correct. Now, can you IPO in other countries? Would there be less regulations?
Absolutely. So you can absolutely IPO. I mean, there's so many different exchanges. Everybody wants to IPO, in the US because it's more, prestigious and things. But some companies do dual listings. So let's say they're in Germany,
Yeah.
they're in Switzerland, they're in the Philippines, and they'll also list here. So
Oh,
that way they
wow.
have access to a bigger investor pool. So yeah, you can definitely do that. You can dual list. I mean, there's just a lot of things you can do with it.
Oh, that's great. Okay, let's touch on fundraising. Alongside fundraising, do you have experience dealing with investors? And if so, what do they look for, or how can we go about to get an investor to close their equity gaps?
Okay, are you looking to are you looking to acquire something, or what are you
Yes.
raising the money for?
Yeah, so acquisition related. Let's say we're looking to buy a company and we need to cover 5-10% equity gap. Let's say it's about $500,000. How can we go about that with an investor?
Yeah, yeah. So I don't usually work on that side of it, but and the reason I don't is because I get so many deals daily. Like I just need,
Okay.
X amount of dollars. But
Right. Hey guys, give Rahim a second. Looks like his audio dropped.
okay, sorry about that. I dropped
Yeah,
off.
you're good. You're good.
Yeah. So, my colleagues who do that type of business, one thing they look for again is a very strong business plan.
Right. And in regards to
So
a
they tr-
business, in regards to a business plan, we're talking about like what's the overall mission and vision.
Exactly. So you can say, hey, we're looking to, roll up synergy businesses in this vertical. And if they, they see an aggressive business plan, they usually do, right now, and, to acquire a business, I'm not seeing as much capital flowing because people are like, well, hell, I can just go buy that business. Though, if you needed like 500 grand, I can go do it. If you're not putting any money in yourself, they
Right.
definitely usually want you to have some skin in the game. But what's kind of crazy right now in the IPO game is if you have a core business already, and it can be in any vertical, it could be unrelated to what you're trying to buy.
Yeah.
You can actually use that to go public and acquire that other company.
Oh yeah.
So yeah, as
Oh,
low
wow.
as like 100K in revenues, and you're like, hey, we already have a core business. So now the bankers are going to say, oh wow, he already has a business, so we're just using that to roll up this other one. We will give him the
Oh.
cash for it.
So that's like basically your track record, so to speak, right? Like here's my collateral.
Right. Right. And, I don't want to get, I don't want to get anybody some ideas, because I think, this is kind of like high level G4 classified,
Right.
type of stuff. But I've seen things where, let's say you own a hotel, right?
Right.
And it's like, I'm trying to acquire hotels, right? I'm like, hey, we're
Okay.
buddies. You got hotels, look like good business. I want to get my own hotel. I don't have a hotel. And I'm like, can I borrow your EBITDA? Can I borrow what your company is doing? So that I can, get my own hotel. It's not going to cost you anything. So you're like, okay. So you put me on. There's a partnership agreement. You
Right.
put me on. Now I can use your business and say, hey, this is my core business, and I want to go public.
Oh
I can take us
wow.
public. I can give you some cash, and I get my hotels now.
Wow. That's amazing. I
And if it
never heard
doesn't
of that
happen,
one. Yeah.
if it doesn't happen, it just reverts back.
Oh,
You see,
good.
it just reverts, but you didn't lose anything. We'll draw it up that way, so there are just so many different ways, so
Mhm.
you always hear me, in the mastermind group, you always hear me,
Right.
do you have a core business? You always hear me ask that. And the second question is, what's your relationship like with the seller? Are you guys really cool? Does he like you? Because if he or she likes you and you explain it to them the right way, they may go for it and say, whoa, this can work out for both of us.
Makes sense. Yeah, that's what I like to tell people, coming in and negotiating and being like, hey, 4 times take it or leave it. That's not how it works. The business is their baby. They've grown it for even decades. You think they're going to let a little punk come take it like that? No, you got to sell them the vision.
Right.
You got to sell yourself on why they should work with you. A lot of people have this
Exactly.
misconception of a motivated seller, right? But honestly,
Right.
it's honestly, you got to motivate them. That's how it is. What they do have
Yeah.
is an interest in hearing what you got to say. Then it's up to you to pitch
Yep.
them, right?
I totally agree.
Let's talk.
And I think people,
Tell me.
go ahead. No, people will see, Dan Pena, and they'll see, he's kind of forthright in this. But here's the thing: Dan Pena is a businessman, and he's very charming. You see, he knows what to say, what not to say. He knows what role to play to get it. He's not always mean, mean Dan Pena if he wants something. He will change depending on what he needs to be. And I think a lot of people need to understand that. You can't come in there saying, this is the deal, take it or leave it. No.
Yeah. We're humans. We have emotions. And at the end of the day, it's more about the trust than the money. They just want to make
Yeah.
sure that you're going to, build upon and continue the legacy they've created, right?
Exactly.
And one thing to distinguish, Dan says he's a hammer closer, not a hammer negotiator. So closing is different. And he says specifically when you've invested and come to a point where you both agreed and now they're trying to pull back. So always take
Right.
the high road. Now let's talk about equity and fundraising. When you're starting out and you need to raise funds for a deal, how much equity would they want? And can it, and this is my question, can it be just against that deal or does it have to be against the main corporation?
Okay, so you have a business and you're starting out and you're trying to get like seed funding, or what are you trying to do?
So let's say I'm looking to acquire a business. And I'm looking to raise funds to, finance a portion of that. How much equity would they take on my deal? I've heard, let's say the standard rule for investors is 30% no matter the amount. I don't know if that's true, but if so, if they're taking equity, can it just be for that deal or do I have to give up a portion of the main company?
It really depends on what you negotiate, and it depends on the size of the company. I mean, for me, dealing with the public route, I hear, VCs taking, a big chunk of money when they go public. And, when we do it, we want to leave the person with, 80 to 85% of it. But,
Right.
if they go the VC route, they're definitely they're gonna be taking, taking the what out of them if they can, because that's how
Yes.
they make their money. And every raise, they're going to be giving up more and more equity. And I'm just give you a quick story. When I was at DoorDash,
Please do.
I was talking to Tony Shu, who's the one of the founders,
Yeah.
and a nice kid. They're all from Stanford. And we were talking. This was it was either a Wednesday or Thursday night, and this is in San Francisco, so we're sitting there. People are having beers. We're just
Right.
talking. I'm like, so what are you trying to do? And he's like, I don't want to take on any more debt, man. I just want to, pay off this debt, and, get this back, to where we, our original mission and stuff. We had a good talk, and then I
Right.
would say Monday, it was boom, we took on more financing. So it was like, okay, that goes out the roof. So he gave up more equity too,
Right.
But, once you take that money, it's almost like it's not your company anymore. You're kind
Exactly.
of working for the VCs.
Exactly. Now, let me touch on search fund now that you say that. The search fund model, and I was listening to us, essentially is from Stanford, if I'm correct, is the model of entrepreneurship through acquisition. And what you have to distinguish between what we're doing, which is acquire multiple businesses, and a search fund, is that the search funder wants to be involved in the day-to-day operations. For example, I'm a doctor and, I've worked for a company, but now I want to have my own practice. Instead of starting one, like we said, 95% failure rate, let me buy a practice and take over. That's essentially what it is. And what happens is they're bringing investor backing, but the investors are going to keep 100% of the equity of the company, and they're essentially working to pay that back. And if so, they could buy back up to 30% of the equity, but that's more of a if you want to be involved. Our model, the reason we get involved with commercial debt is because it does not dilute equity. What it means is that we're looking to acquire multiple businesses. So if you're going that route, don't go the search funder route, because that's more of an involvement in the day-to-day. Now, what happens if you're not producing the returns? This big. What happens if you're not producing the returns your investors were expecting to get? As long as you pay their money back, are you good for the time being?
On a search fund or on what?
No. On an acquisition itself, you get investors. You say, hey, we're going to acquire this business. We're going to be able to provide you returns of 15%. And you're not hitting that 15%. Let's say you're hitting 10% or 8 or 9%, but you're still paying their money back. Are you good for the time being?
It depends on how it was written up, really. If it's something, if you say, hey, we have a target between, 5% and 10%, that we can give you,
Okay.
it really, yeah. It
So
really
if you
depends.
say
And it depends
something
on what
very specific is when you get in trouble, essentially, right? You want to keep
right,
things open?
right. So like when I was at Julius Baer, we were doing equities. We would say, are you familiar with the term alpha?
No.
Are you familiar with? Okay, so what it is like you have the stock market, right? And these are,
Right.
we call them indexes, whether it's Dow Jones, MSCI, whatever. We would say, okay, we're going to give you whatever they give you, whatever the market gives you, plus 10%, and that's our alpha. Okay.
Right. Okay.
So if you just put your money into an index fund, you're going to get what they give you, and we're going to give you more. That can kind of get you in trouble, but it's also why they're going to invest with you as opposed to just throwing your money into an index fund. So I think
Right.
that you can get in a lot of trouble when you do that, but that's kind of what they're paying you to do.
Okay. Makes sense. Now, what type of added responsibilities do you take on when you're dealing with investors' money?
It depends. If it's public or private? If it's public, you definitely have all the disclosures, and you definitely always have a fiduciary relationship with them. So you want to do what's best by them.
Right.
But that's pretty much it. You definitely want to work so that you're always doing things that are going to increase value of their investments.
And if it's private, I heard, you don't have to deal with the SEC unless the money's passive. Is that correct?
Right. But that's you're dealing with PPM, private placements, what they call private placement memorandums and things like that. But, the same thing applies. You have a fiduciary responsibility to them to, do the best to make sure that they have a positive return on that investment. Either way, whether it's public or private, you're obligated to do that.
Right. Family offices. Do you have any experience with them?
You know what? I have a lot of friends in family office. I personally don't. I mean, I know that they're highly secretive, and they do like to invest, but I definitely not my cup of tea.
Okay, let's talk about angel investors. Do you have any experience with that?
Just a couple. I know some people who have came in very, very early stages with a couple companies. I've never done it, but I just have a couple colleagues who've done it.
Now, my question is, are they really angels? If you know what I mean?
It's funny because I was at a conference in San Francisco right before COVID, and I met a bunch of people there who were, angel investors looking for stuff, but not really, depending on who you want, it's kind of like, you're kind of selling your soul there to some.
Oh,
Depends
wow.
on, who they are, their track record, but there are a lot of good ones out there too. But people have to understand, everybody wants a return on investment. Period. Like you
Right.
said, it's money, so that's what it all comes down to. Jerry Maguire, it's not friends, it's not show friends, it's show business. It's, you have to be able to show a return.
Right. Now let's touch on SPACs. What is it? What's a SPAC for the new guy who doesn't know about it or hears about it?
Like from the beginning?
No, just a basic overview of what a SPAC is or what it comprises of. What's the purpose of it?
Yeah. I mean, we definitely hear it. We hear it in the news all the time. It seems like every single day. So it's a special purpose acquisition company is what a SPAC is, a special purpose acquisition company. So it's an acronym, right?
Right.
And what it is, it's a blank check company. It's very similar to private equity, where a bunch of people get together and say, hey, we want to raise money so that we can buy companies. However, we don't know what those companies are yet. We don't know what the target. So that's why, because they don't know what they're going to buy, they're also called a blank check company. Okay, so they're raising money so that they can go out and buy companies, but they don't know what the target is yet.
Okay, makes sense. Now, if any business you acquired through a SPAC will be public, would that be considered essentially a reverse IPO?
That's one way to look at it. That's probably a really good way to understand it. It's a really good way, and I kind of do it like, I kind of explain it like, whether it's an reverse IPO, RTO merger, I kind of look at the story like Spider-Man. And you'll start to, the more you talk to me, I try to break things as easy as possible, right? So you have, Peter Parker, right? And then, he kind of represents, one company. And then you have that spider, right? And that's kind of the company that's already public. What happened? The spider bit him, right? That's the reverse merger process. And what happened afterwards? He was this big, huge humanoid spider.
Right.
Okay, that's the newly formed company. That's kind of the way I like to look at it.
Great way of looking at it. Easily breaks it down. Now, if you're a public company, how can you go about becoming private again?
Yeah, there's ways to do it. You can definitely take companies private. Dell's definitely a famous example of that. Dell Computer Company was private, went public, and then it went back. So they buy shares back. Okay. They just do a share buyback and they take them back public. It's not as common as it used to be, but it definitely does happen.
What's the amount of shares you have to own? What's the percentage to be able to go private?
I'm not sure. I don't know if it's a share amount, in as much as it is, the board just says, hey, we want to do it for this reason, and we're going to pay those people out to, buy those shares and go back public. And you'll see it a lot of, it's kind of funny when the whole COVID thing, or, even when President Obama was in and we had all those quantitative easing, we gave to the airlines, all these, billions of dollars, and they didn't pay their people with it. They did stock buybacks. So now they're owning more and more of the company. You see what I'm saying? Or they did acquisitions with the money,
Smart.
So it's, it definitely happens.
Right. So do you have to put up the initial 20% for a SPAC, or can you get investors for that?
You can get investors, but when you're dealing with SPACs, you're dealing with big money. You're dealing with like 100 million, 200 millions and things like that. It's not really for the small guys, and that's what I try to tell people. So you'll hear a lot right now about people talking about SPAC this, SPAC that. It's for the big, the big guys are really doing it right now. There really isn't a way, even with Reg A+, which I think is amazing. You cannot go public. You cannot go SPAC with a Reg A+.
Yeah, to clear the misconceptions for a lot of the gurus, they now figured out the word SPAC and they're all over it, right? So
yeah, exactly.
A question: if you're already public, through the SPAC, you acquire a business, you're already public. Would your exit basically be a sell? Just sell it?
I think the exit is when you acquire another company, because that's that's going to comply with Rule 419, because you have to merge into something in accordance with that. So that's kind of your exit right there. And so you have the blank check company. Boom, you bought something. the share should go up because now you've got your first target. You've got that, that operating income. You have all those other things. So that's pretty much your exit on it. But you could, I mean, like any other company, I mean, you can sell it, but the whole point of it is to acquire other companies.
So basically, in other terms, like I've seen the example with a bond is like a credit line, so to speak, money backed already, ready for you to deploy into an acquisition, right?
Exactly.
Because that's the biggest issue. People get the deal, they don't know where to get the funding. Now you got the funding, so it's easier when it comes to that, right? You got the deal, let's roll.
Yeah, it would be like, your kid is, wants to go buy a car and you say, here's a check, go get a car. Okay, go look for a car. He doesn't know which one yet, as opposed to him working at like McDonald's saying, man,
Right.
he's making money and he has to go find, it's the other way around.
But
He
when
has a
you got
blank check
money,
to
you
go
got
buy whatever
options,
he wants.
right?
Exactly.
Yes. Now, okay, let me ask you this. How is that money? Can you be like, hey, let's say you got 100 million in your SPAC. Can you come to these businesses and cash out these owners like, hey, I give you everything up front. I want it cheaper, so to speak, when you buy everything cash? Can you do something like that?
Yeah, usually you're paying them in shares anyway. Okay. So a company is worth, let's just make it simple, $1 million. You're not going to actually hand
Right.
over $1 million. Well, some do. You're handing them over that amount in shares. But yeah, you can definitely do that.
Okay, explain that. I've never heard about that. So essentially, your SPAC, the $100 million is basically $100 million worth of shares. And instead of you giving them money, you're giving them shares valued of that amount for the transaction?
Yeah, exactly. So when you hear all these big
Uh-huh.
things about this company acquired this company and all that, they're really not changing cash unless you'll hear they bought it for X billion dollars and they'll say plus cash. Okay. So most of it is going to be in shares. Like let's say
Right.
Facebook will acquire something. What Facebook is doing is giving them shares of Facebook. They're
Right.
giving them shares and those shares are liquid. They're tradable.
So
Okay.
they
And
could
they may
cash it
give them some
out.
cash on top. Right. And they'll say sometimes they may give them cash on top. It just depends on what they want. But usually it's just a share exchange.
Right. Okay, let's talk about the S1. Is there a reason, a way
Mhm.
to file an S1? Like we're creating a platform in healthcare. We want to exit in 5 years. Should we go public sooner? Should we start, that process sooner?
I'm an advocate of starts, go public sooner rather than later because you want to preserve as much equity. And like I told you, you're going to, hopefully 10x your company because your company is going to be worth so much more now. And it's just going to look better in the eyes of people. Everybody wants to do business with a public company. Everybody wants to work with a public company. So you file that S1 and things. Let's say you need a CFO, right? But the only CFOs that you can afford make 100 grand a year, and you need
Right.
one who makes 250 grand a year, right?
Right.
Now, when you go public, you can say, okay, I will give you that 100K salary and I'll give you X amount in shares. Now you can get that 250 grand a year CFO. You see what I'm saying? So
Right.
it really helps you elevate the brand. And you're just, it's just so much better. So many more things you can do.
I
You know,
see that perception. Going public is like getting that fame and glory in business, right?
yeah. Yeah, you're sitting at the cool kids, tables, and you're able to attract mergers and acquisitions, strategic partners. It's going to increase all of that. You're going to be able to compete with large corporate contracts because you're a public company. You see, because like I said earlier, the
Yeah.
kimono is open. They see everything that's going on there. So they know what kind of health the business is in.
Right. Okay, is 10 times the average or does it depend on industry?
It really depends. I like to say 10x, but it really depends. Some are more, some are lower. But it just really depends on the industry, what they're doing, how well they're doing things. It's a leverage tool. That's the way I tell people.
Right.
It's a leverage tool, and it's not just about raising money. Raising money is just one part of it, but all the other things that you get with it. So I don't want people to hold me to it. You said 10%.
Where's my
You
10
know.
times?
Right, but one of the biggest, I would say, with the baby boomers and everybody right now, those are
Right.
probably my biggest clients, people who are looking to retire, right? And they may say, I don't want to give it to my greedy heirs, let's say something like that. They can pay them off in shares. I had a
Right.
guy in Orange County, and he Mexican guy, really, really smart guy. He owned
Yeah.
it was like a chrome plating, nickel plating, all this other stuff. So he had it for sale. And he couldn't speak English, so he had his business broker there, and we just
Right.
hit it off really well. I'm looking at it, and I'm like, man, this is a really good business. And this dude was doing monster money. And what he did, what
Mm-hmm.
was so cool in North Orange County, he was the only one who could actually do the plating. Everybody else there took it to him.
Oh
So every
wow.
other shop you saw in North Orange County,
No
he just like, this
competition.
guy was just on, yeah,
Dominate.
no competition. This guy was like on his business. So we're
Wow.
sitting there and I'm like, okay, man, I got to ask you, you have a great business. Why do you want to sell? And he's like, oh man, my ex-wife. I'm like, what's going on? He goes, man, I need to pay her, man. Like,
What?
I said, how much? Yeah, he's like 250 grand and all this other
No.
stuff. And I'm like, so you want to keep the business? He's like, yeah. I'm like, dude, what if we go public, okay? And you pay her in
Mm.
shares. She's done. She's done. You gave her the shares.
Yes. And
You
you
and
keep
your
your
new
company.
girlfriend can
Yeah.
exactly. So that was a way out of it. So it's just
Right.
using it, of like succession
Leverage.
planning and things like that.
Right. Okay, let's talk about this. Being married, how does this affect your company? We saw the Jeff Bezos with his now ex-wife. Do you think it's don't want to throw things out there, but you think you see it more as a liability, or do investors see it more as a liability?
I don't know. I think that would be more of a legal question, and I'm definitely not qualified to speak on that. I'm not sure. I just know, California is a, community property state, but I don't
Yeah.
know what happens. It's when you're dealing with, public corporations and things like that. Yeah, I think a legal expert would be better to
Okay,
ask
sounds
than
good.
me on
Okay,
that
let's
one.
move to this. Does the amount you raise determine the amount of stocks, or is there a standard?
Well, yeah, you usually come to a pre-IPO valuation. I think DoorDash was like at $83 and it went up, that first day pop, which is a whole different story. But that pretty much, yeah,
That's where
it
billionaires
depends
are
on your
made,
valuation.
huh?
Yeah, totally different story. But yeah, it depends on your valuation.
Great. Now, what's the amount of stocks your company can issue?
It depends, like I said, on the valuation. You can, whatever your valuation is, and you say, okay, we want to raise $1 million, and then you get your
Yeah.
valuation. Okay, so that means the shares are going to break down to this, what's
Okay.
available. So yeah, it's really, you gotta kind of got to know the valuation
All right, let's
first.
talk about this. When raising funds, how crucial or critical it is to get the amount you need at the valuation you want?
Well, there's always companies that come in under the valuation, always.
Mm.
And there's some that come in under. I just had one that we did, which was a Chinese company,
Yeah.
and because of the, all the stuff that went on, with the trade stuff and all that, they came in under. So it definitely
Right.
happens all the time. It's not necessarily a bad thing,
Yeah.
but it's just the company didn't earn the money that they wanted to earn.
Okay. When pitching other investors, do you have more leverage if you have a lead investor? That way you can retain a great valuation, so to speak. Like, hey, we got this guy. He's our lead investor. He's putting in $2 million. We're looking to raise more funds. Does that give a better perception, and can you retain more like that?
Yeah, I think if you're doing it, like the that would be more of the Wall Street way. If like you have like a lead, like you say, underwriter who's saying, hey, I'm going to be responsible for X amount of shares. That's always good, because then everybody else will kind of jump in on it, and kind of have this feeding frenzy. Like DoorDash is one, the lead underwriter was Goldman Sachs, but a lot of other ones jumped in, so that definitely does help. And if it's a big name, yeah. Now on the smaller side where I do it, it's a broker dealer who does it. And if that good broker dealer kind of signs his or her name behind it and say, hey, this is the company, that always helps.
Right. Now, can we go? Okay, so I understand going public depends on the value of the business, but if we acquire a business that meets criteria, can we go public with one acquisition?
What do you mean? So you have one company,
Yeah,
and you
you
want to
acquire
go public?
one
Yeah,
company.
you can do that.
Yeah, you can
all
do
day.
it. Nice. And
Yeah, all day. All day.
What minimal deal size we're looking at?
Like I said, the lowest I did was 100K, which
And
was
that was
little.
100K
And
sales?
yeah, 100K in EBITDA
And
is
EBITDA?
what they
So
were doing.
if I could acquire a
Yeah,
business at $1 million EBITDA, we're good to go public?
yeah, because you have that core business. You see,
Do you think
you
that's a
have that
better way
core
to
business.
approach your roll-up model or your growth model? Acquire one, take that public, and now use that leverage to keep building?
That's what I tell people. That's exactly, and it's just so much easier. Going public when we do it, on this, it can cost anywhere from 75,000, to 100,000, for a regular S1 IPO. If you're
Right.
going, like Reg A plus, that can cost you about 125K. plus, whatever, a little piece of whatever you're earning, plus some equity and things. But it really depends on if you are the right fit for a Reg A plus. So
Right.
and you have less reporting requirements with Reg A plus too. So, but it just really depends on what you're trying to do.
Okay, let me ask you this. That really gave me more ideas. Now I got to go to a notepad thinking about that. But in regards to the current economic situation we're facing, COVID, do you say should we avoid going public at this time? Should we wait, or it doesn't matter?
I have been busier than ever since COVID. Companies are
Oh,
like, we
wow.
want to do it now. We want to do it now.
Yeah?
And so here's the thing right now.
Tell me.
Everybody's competing for that same money. You see what I'm saying? Everybody's competing. So it's really, really hot right now. So everybody's trying to get in on it.
So you're saying if you can do it now.
If you can do it now. And like I tell people, if you just have a core business, it doesn't even matter. Let's say you're trying to buy, like you're in the healthcare space. Let's say you're trying to buy a CRO and you own a little UPS route company, but hey, it's a core business. We can probably do something with that.
Oh, wow. Ryan, can I put your information? Can people reach out to you? I know there's some people that are interested in that.
Yeah. So I can give you my email is Ryan at therelentlesscompanies.com. So just let everybody know I'm a sole practitioner, but I have a network of some of the strongest people in the business. And so we throw deals around, we put deals together.
Yeah. You're the connect, man. You're the guy who knows how to put things together.
Yeah, I like to think of myself that way.
So we'll put your information in the description. Let's run through a couple last questions. Now, what regulations are we facing as founders when we go public?
A lot of it depends on the exchange that you're going to list on, and they have their own regulations, and and it's going to cost different. I think it's $10,000 a year on Pink Sheets, but then when you go to NASDAQ, it's going to be more. You go to NYSE, it's going to be more. Everyone is different, and so what a lot of companies that I work with do, they'll start off at, let's say, OTC, or something like that. Then they'll uplist later on to like the NASDAQ. Once they get the the money to where they want it, they'll do an uplist, and that just means you're going from one exchange to another one.
Right.
But yeah, everyone's different. And they all have different requirements.
Right. What determines the amount your stocks are worth? Is it basically the amount you raise?
It's the valuation.
Mm-hmm.
It all goes back to the valuation is what's going to determine that. After it's been public, it's what you do. What are you doing to raise the price of the stock, or go the other way? So,
very quickly, just to put it in a simple perspective, when you get your valuation and you go public and you got stocks, essentially your company is broken down into that amount of stocks that is issued, and each stock is equal to amount that once you add them all together equals the value of your company, so to speak, right?
Well, then you have market cap, which is outstanding stock too. That's out there available. So I tell people to think of it, kind of like a pizza, right? You have a big pizza, that's the company, and stock is a little bitty tiny piece.
Okay. Well, what is market cap based on? Is that pro forma?
No, it's based on the value, based on how many shares are outstanding. Let me get you the actual definition, because I don't want to foul it up.
No problem.
So yeah, it's let's get it here. Okay, so our good friends at Google tell us the market value is the value of a company according to the markets based on the current stock price and the number of outstanding shares. A higher market value than book value means, and that's just all this other stuff. So yeah, it's the outstanding shares is the big thing, and the stock price. So you may say we have 1 million outstanding shares based at $5 each. We got 5 million. You see what I'm saying?
Yeah. What ways can we go about raising funds? Okay, let me ask you this: what's your favorite way?
It really depends on the company. If I have a DTC company, and that means direct to consumer, right? I have a company that's Sugar Fiend is a company in LA that makes candies for adults, a really cool company. They're currently doing a Reg A plus. So what that allows them to do is have everyday investors just like you and I, not accredited investors, people who used to get in early, who make $1 million a year or $1 million net worth. Right. They can all pitch $1 here, not $1, but $100 here, whatever, and own a piece of it. Those are great for direct to consumer companies because you're turning your customer base into owners of the company. You see,
Yeah.
and a lot of them aren't really worried about a return on investment. They just want to see the brand do well. So that one is really hot right now. March
that's
15th.
nice.
The amount goes from 50 million that they can raise up to 75 million on March 15th. So that's going to be really cool, and that's one of my favorite ones right now.
Oh wow. Would we have to put skin in the game if we have a core business, or would that core business be the skin in the game?
Your core business is the skin in the game.
Okay.
So yeah.
That's your collateral. Hey, I got this. Let's roll, right? I'm willing to sacrifice this. Willing to sacrifice my baby. Okay, so
yeah, they just go ahead.
No, finish.
Yeah, they just want to make sure that they just don't want you to be this guy saying, "Hey, I want to buy this business. I have no money. I have no collateral. Give me money." They don't like that.
Beggars.
But if you say, "Hey, I want to buy this business. I have this core business over here. It's doing X, Y, Z. I want money for a business," then they'll talk to you.
Right. Okay. Let me touch on this. I share with people leverage negotiation, where essentially, if you don't have nothing to negotiate with, if you don't have leverage, you're not negotiating, you're begging. Just like you said, I don't have money, I don't have none of this. Would you please invest in my idea? Would you please invest in that? Instead of, hey, I got this business, this is what I've created. I want to take it to a next level. This is what I'm willing to put on the table, right?
Mm-hmm.
Okay.
Yeah.
So how much reporting is involved with Reg A+?
I don't have the actual there, but you definitely have to show people what you're doing. I think the big thing, though, that people need to understand about Reg A+ is that it's not liquid. It's not liquid unless it's a Reg A++ IPO. So you can do Reg A+ and you can raise funds. You can raise up to 75 million, like I said, March 15th, but you don't have to go public with that. You see?
Right.
So until they go public, so those shares or that what you bought, that equity bought into the company, there is no place for you to sell it. So people have to understand that when you're investing in these Reg A+ deals, your money may be tied up for a while. If you're not comfortable with that, you probably want to go with something, on the equity markets or, more of a retail investor thing.
Right. Yeah, no, that's great. So let me ask you this. If we raise funds, let's say $1 million from investors and it's in the business account, can we go public? Let's say if the company isn't cash flowing, we raise $1 million is in the business account. Can we go public with that?
Yeah.
Yes?
Pretty much that one. Yeah, that one. You definitely want to you have to disclose your financials and show everything that's going there. But
right.
you may not get the valuation you want. But a lot of it, when you read these, S1s, you read all these things, it tells you exactly what the business is doing. And they'll say, you have to list out what are some of the risks of this investment, and you have to let the people know. So you're going to be disclosing all that anyway, and people will look at it and say, hey, I want to invest in it, or they don't.
Makes sense. Now, appreciate that very much, Rahim. Let's open it up to a Q&A. Can you explain what a direct public offering or a DPO, direct public offering or direct placement is, and the difference with an IPO?
Yeah, so a direct placement is like, a company has issued shares to the employees, or, they already have shares out there.
Yeah.
Hold on one second. And they're just offering those to the public. It's just a different way of going public. Like I said, there's so many different public offerings. We always hear about the IPO, but that's kind of a direct placement. So it's just you're selling securities directly to the investors without a middleman, such as an
investment
Goldman
bank.
Sachs or an investment bank. There's no middleman involved. It's just like, these are the shares, we're going to sell them, and that's it. Wow. And Slack actually did that. Slack was one that did it. And I think one of those music streaming companies did it as well. I can't remember the name of it. But
Spotify?
I think it was Spotify. It was like a year or two ago. They did the same thing. And it's less money, you're not paying, 8% to the iBankers.
Right. So we can get a valuation for the business based on the funds investors put in?
That would be only part of it, though. That would only be part of it. You definitely have to see what the business is doing, right? It all comes in, money in, money out. That's just part of it.
Okay. Look, can the board of a SPAC take a salary? And if the SPAC hasn't merged with a company within the 24 months, funds are just returned to investors, correct?
Yeah, because that's Rule 419 that I was talking about. So they have to find something to merge into really quickly, or that's that's one of the consequences of it. As
Right.
about the salary, I'm not certain about that. Like I said, I haven't done a SPAC. Those are the big boys. Those are the big, the Goldman Sachs and
Right.
things like that. So I can't answer that question directly. I would have to look something like that up. But I would imagine they could earn something off of it, but I'm not certain.
Right. There might be something because you're in the search, right? You got to live. So,
Right, right. There has to be something. Even with private equity, there's management fees and things like that.
right. So how do board members get paid? The board of directors.
For what, public companies
Yeah, for a
or?
public company, is it just salary?
Yeah, it depends on what they've negotiated. Some of them get shares, a lot of them get, shares in companies and things like that. But every company's different, and they may be a hybrid of it. It's just that's kind of getting into the weeds because every company's different there. But they're usually it's in shares.
Right, right. So what is the process, very simplified. What is the process by which a public company is bought out? How do they go about that? You just buy the majority of shares and take it over?
Exactly. You're just buying the number of shares, the outstanding shares or whatever. And like I said, you can offer some cash for it or whatever it is. Um, which was in the 80s was, like I said, the corporate raiders leverage buyout type things where you're buying it or they would take it over with debt. I mean, there's a million ways to do it. But usually if it's a public company, you're saying, hey, we're offering to buy your shares at this price. And that's how they'll get it.
Right. Okay, let me ask you this. If we're a private company and there's a lot of people that are starting out in the smaller ranges, the smaller businesses, right? Where
Mhm.
essentially there's only cash flow to service the debt, pay somebody to run the company the day to day, either the owner or a replacement, and something left. How will we go about to pay the board members? Would it be just a cash bonus post transaction and salary later on as we grow? Or are they like just partial board members that get paid basically a commission for the acquisition?
Yeah, I can't really speak to that because each company's different.
Right.
I'm more in, like I said, unfortunately, I'm on the IPO side, so I can't speak to that. Yeah, I'm definitely. It's just not something that I can speak on.
Hey, Rahim, I appreciate it. Let's kill it here. I don't want to take much of your time, but guys, thank Rahim. We're going to put his information for you to be able to reach out. This podcast was amazing. This episode was amazing. And it's a different perspective. You see all the Facebook investors that think they're gurus. Now hear from the guy who actually takes the companies public. So I appreciate you, Rahim. Thank you very much for
Hey,
coming on.
Appreciate you being on, Raheem.
hey, Ansi, Valentino, thanks so much for having me, guys.
Thank you. Guys, number one M&A podcast in the world. Make sure to follow up for the new episodes. We'll be bringing in some other guys, financial directors.